Hey, what's going on everyone? It's Alwyn here with another video. I hope you guys are all having a wonderful day as always. Today we're going to be getting into Jim Cramer's Mad Money from actually tonight, which is Monday, March 29th. So let's get right into it. So the first thing that we're going to go ahead and cover before we get into it, make sure that you guys do go down below and take a look at actionalerts.com, actionalertsplus.com. It's a great service that Jim Cramer runs, and his Real Money column, which he posts on every morning. So let's get right into it. The Dow Jones was up 0.3%. The S&P was down 0.09%, and the Nasdaq was also down 0.6%. So overall, 2 out of 3 indices were in the red for today. So in terms of his buy, sell, and holds, what he was kind of going for, same idea here. We'll talk about the counter trend as we get into this next segment here. But again, we're focused on the cyclicals, even though today the cyclicals did drop, and we'll talk about exactly why that drop occurred. Okay, so again, we're focusing on the bank stocks. There's a lot to cover, obviously, with the bank stocks today. A lot of them Credit Suisse that we'll talk about, and we'll get to that in a second here. Industrials would be another one to kind of get into, right? Our cyclical boom and bust stocks. And then our Walmarts and Costco's, right? These are our retail plays that are still very lucrative. We know that Larry Williams, he's very, very good chartist that I think was on the show. I want to say he wasn't on the show, but I think Jim Cramer went over it last week, sometime mid last week. And we've always seen this trend of, around the Easter time, we start to see stocks like Walmart, Costco, Shopify, Amazon, right? They have a trend, at least historically, of going up over the last, 30 years, 16 years, X amount of years, for a long period of time. So we did see that run up here with Walmart and Costco, but Jim Cramer says there's still more to run, so it's a good trade if you do want to play that. Bed Bath & Beyond was one of his calls. He said that's a good one, just be careful, because it was short squeeze, but the company is good overall. BFT and WPF, which are both, keep in mind, these are both going to be SPACs, which we'll get to a little later here. Definitely, want to be kind of careful around those, but they are, in a reasonable price range. PaySafe, being one of those companies that they're looking to acquire. They're acquiring tomorrow, I feel like. Very, very good options that Jim Cramer bought on the show, so definitely take a look at that with Bill Foley there. And then, hold on to Uber. We really want to wait and see kind of what's going on here because, they have a big part of theirs, a lot of Uber Eats and things like that, right? A lot of this industry is kind of the food delivery industry has been kind of getting consolidated. But, with the reopening, do people really want to deliver their food? No, they want to go out. That's the biggest thing. DocuSign, wait on that. Teladoc, wait on that. These are stay-at-home stocks. We're going to the reopening, so you really want to look at these, and see how they'll hold up in their quarters. Again, start, we're going to get to this later on. It's a very, very important point, especially to know how to offense, is that start trimming tech, right? Start getting out of your tech, even if that, means you have to, cut some losses, or if you're a profit, like, if you're profiting us back 50%, take your gains, book the profits, and put those into your cyclicals, reopening plays, the boring companies, as Jim calls it. Right, take some of your profits, even if you're losing some, that's fine. You start looking into these other options because that's kind of got out of style on the Wall Street fashion show. XL Fleet is one to kind of stay away from, and same with Oscar Health, which is an insurance-based company, health insurance-based company. Okay, so the first thing that we have to get into here is the margin call meltdown. This was his first segment here, had to do with Archeos Capital, which was the big news of today. Essentially what happened is that it was forced to liquidate over $30 billion of stock. Why? Well, there was a margin call, right? There was forced liquidation. Why? Because they had such concentrated positions in companies such as, mainly Chinese companies such as Tencent and BIDU, but even American media companies such as Discovery and Viacom. So those stocks were going up. Like I think Viacom was up at $90 once upon a time, and it fell halved to $45 a share as of today morning, right? So Viacom really got cut down there. But these were like, heavily concentrated positions, more than 10% of the company, which is not allowed. And they were heavily leveraged up to like 5 to 7x, which is just ridiculous. And they were, obviously not doing some legal stuff. They were just being over leveraged, and they were going to different banks and getting a ton of money, and that's what kind of resulted in this. What kind of resulted in them getting this margin call and like this becoming public information, or like, everybody found out about it? It was most likely Viacom's secondary offering here. What happened there is that they had a secondary offering of around $3 billion in stock, and that sent the stock down. Then they were forced, banks started calling them, back, because like, hey, you have a very, very large position. They start, forcing them to sell or force liquidation, and then that just caused this big, because Viacom stock started to drop as they got, liquidated, or they got margin called, and the thing just keeps getting worse and worse. They were at, $30 billion over that they had to liquidate, just because the banks want to make sure they're cutting losses as soon as possible. It's not for them to profit, is what Jim was saying. But the liquidation does hit a lot of these stocks, such as Credit Suisse, NMR. These are companies that they did come out and say like, hey, this will be affecting, especially Credit Suisse said that it will, result in significant losses for the quarter. Goldman Sachs, however, said that this will not have any, losses, very small, will not have an impact, because they were really, really quick in cutting the losses, liquidating these shares to the public market as soon as possible. So that was good. And then coming to this idea of a great reopening, the great reopening did take a breather today, and we did see that counter trend rally, right? We were going into the stay-at-home stocks today instead of the reopening stocks, right? Because of all this going around with Archeos. And one more thing that we'll just get to shortly here with the doom and boom segment. But the reopening was put on a standstill just for today, though. But what does this mean for the larger market? Jim Cramer says, guys, it doesn't mean anything. We're going to forget this in one day. We'll get to this at the end here. But we're going to forget about this. This firm has had bad history in the past. The firms knew this, but they went unflagged, at least this time. But the firms knew they had a bad history. Firms really get addicted to the, commissions that they get, because it's such a large scale. They're getting so much commissions that they're, okay. But they're okay with the commissions, and then it crushes them, because now they're the ones bearing the loss, because, the margin calls and things like that. Right, so that was kind of the result of like why that happened, is that, okay, the banks obviously get over greedy, the hedge funds get overly greedy, and when everybody gets greedy, things turn out badly. So we'll come back to this idea of the margin call meltdown at the end here, but another really important thing that, really, really was the focus of today that took us away from, this idea of, the great reopening and pulled us more towards, stay-at-home stocks, was this idea of doom or boom. Okay, this idea of a COVID resurgence, having essentially a premature or an early kind of reopening trade that was going on, or, too early stage, reopening trade, right? What we found out is that the CDC director, she said that might be a fourth wave, there might be a fourth wave of COVID, impending, or an impending boom that's just around the corner, right? So obviously this means that stay-at-home stocks are going to go up now, right? So this crushed things like restaurants, right? Any cyclical things, entertainment, travel, oil, leisure, cyclicals, anything along those lines, all of those would have got crushed, because obviously COVID's coming back. Our focus switches to stay-at-home stocks, right? So that's what we kind of saw today because of the statement released of an impending doom with coronavirus, spiking here. But, investors, just keep in mind, they don't just dump everything and just completely leave the market. They flock back to the stay-at-home names. We have Clorox, Procter & Gamble, companies such as that. General Mills would be another good example, right? And another thing that we have on top of that, so that's one thing here, we have this idea of a COVID resurgence. And then on top of that, we've been talking, especially on Friday in the No Huddle Offense portion, make sure you guys check that out, very, very important, about this idea of inflation. Right, so Goldman Sachs has, launched estimates of 10% GDP growth next quarter, and there is a belief that we are about to, repeat what we have seen in the Roaring 20s when the economy was coming back. So this is 1920 when the economy was coming back from the Spanish flu, which was a big thing at that time. Right, so kind of similar situation now is what people are at least comparing today's world to. Right, and then this is kind of today is known as obviously a counter trend. Why? Because our, stay-at-home stocks are going up, a lot of inflation concerns, right, and things like that. So we're really looking out, and great reopening might be at a, slowdown or at a standstill here. Again, but what really profit off, today's kind of run towards the stay-at-home were the essential retailers, right, and that's Walmart and Costco, and that's exactly what Larry Williams was saying. Remember when it's Easter time, historically, we've seen these essential retailers, especially Walmart and Costco, have increased sales, right? Have increased earnings, and have their, or should say not increased sales and earnings, increased stock price. So it's been a good, historically, it's been a good trade, and that's been doing very well, especially because, just as of today, they have moved out of non-essentials such as Kohl's, right? Such as, Nordstrom, and they've moved into Walmarts and the Costco's. There's also a resurgence of the FANG, right? Keep in mind, Facebook, obviously, they, had their court thing with, Snapchat, I think Twitter, and, Facebook, Google Google, Facebook, and Twitter, I believe they had that thing at Congress regarding how social media is kind of being, monitored. But there was really no outcome from that. There was no, didn't hurt Facebook in any way. Facebook is very cheap. Keep in mind, guys, it only sells at 21 times next year's earnings, which is very, very cheap compared to the cohort. Amazon obviously is going to be our stay-at-home kind of stock, right? Reopening isn't occurring so quickly, so Amazon had a boost because of that. And then in terms of Google kind of has two parts, like we know. It has the travel side, right? Obviously, their advertisement, travel ads, which they benefit from the reopening. But then they also kind of go along with the FANG stocks. Why? Because they're in all of these ETFs pretty heavily. So when the ETFs are constantly buying them, okay, Google is also affected, right? What do we know about this? Well, we know that the counter-trend rally is going to be short-lived, right? It's going to be short-lived. At the end of the day, maybe it might take a little more time, but at the end of the day, we are moving towards the great reopening, right? So the CDC chief did create a sell-off that existed in the market, right? And we know that everybody kind of shifted their focus in towards now the stay-at-home stocks, but it's nothing too important. And what do we know tomorrow? We're going to kind of forget about this tomorrow. We're going to distance ourselves from the Archeos, thing, the doom comments about, COVID resurgence. And, I think we're going to forget it and go past that all. So we're going to, within no time, we're going to be looking at the great reopening again. So that's going to become the focus. So the biggest thing is that there's always a better time to dump counter trend stocks, right? Like we're seeing right now today, even tomorrow going into the markets will be a good time to, take some profits off of the stocks, especially tech heavy stocks, growth stocks that have run up in these last couple of days. Sell them into profit, sell them maybe at a loss, but a diminished loss there. And then, get into the reopening plays. You got a good break today, and that provides you a good opportunity. So that was kind of the doom and boom. At the end of the day, we're still looking at the great reopening. Okay, and then when we go to the next portion here of the show, it was about, I like this a lot, an oversupply. Okay, we've been talking about this a lot, this idea of an oversupply. What's causing the oversupply is very, very broad. We have IPOs, right? IPOs, there's so many IPOs. We have SPACs, SPAC-lash, SPAC-out. Oh my gosh, so many SPACs. We'll get to that. And then we actually have also, down here, we have a lot of secondary offerings, which is pretty important. And then we also have, finally, the insider selling, which is huge. Okay, so we have this huge stock left, right? We have an oversupply of stock in the market, especially for tech and, some of these healthcare names, right? They're just coming out like crazy. Whereas other companies, especially the industrials, are taking back their stock. They've been doing, 10% buyback over the last decade, 15% buyback, even 25% buyback over the last decade, causing high demand during this time because of the great reopening, but also very limited supply, right? So with the IPOs, we know it's been, this is the craziest part, right? It's been the most explosive IPO market, or the most busiest, I should say, quarter since 2000, during the dot-com burst. And here, what do we know? There's been over 100 deals, IPO deals within this year. This was the biggest first quarter in the IPO market, and it was the most money ever raised in one quarter for the history of IPOs. So it's huge. A lot for healthcare, a lot for tech. And what do we know? The deals, they're not getting that lucrative, right? A lot of these, are kind of just not doing as well. Why? IPOs returned an average around 8% this quarter. So it's not as lucrative as it used to be. We know that just last week there were 17 deals, which is the most amount of deals in 1 week in IPO history, which is ridiculous. And half of them from last week broke below their, initial, public offering price, which is just terrible, right? So that's one thing that exists there. And then we know these Chinese stocks, Chinese IPOs are not the best. And then we know we have a Coinbase direct listing that's coming up. And keep in mind what direct listings are is that they don't have any lockup expirations, right? So they don't have any lockup expirations, meaning right when they come on the market, the insiders can sell all their shares. What can that mean? Well, if Coinbase is valued around $190 billion, that means $90 billion will come into the market. And guys, the market does not have a place for that. There is not that much money, just free money kind of floating around. And if there is, that money is not going to tech, it's going to the reopening stocks because the institutional money managers are focused on that way. And then on top of all this, guys, we even have the secret deal of Robinhood going, IPOing during a terrible time when their investors are in a very, very bad position because their names are not doing the best as of now. Okay, then we have the SPAC. SPACs, obviously, there have been over 300 SPAC IPO or SPAC, offerings, as of 2020, as of this year, which is more than what we saw last year in 2020, which is just ridiculous. And now what's important is that there are SPACs trading at less than $10, which is just ridiculous. Why? SPACs, what are they? They're just blank check companies, right? People, investors just throw in money into these companies, right? They're just blank check companies. And now what do? Okay, they have all the source of capitals. They look for a company, okay? They look for Joe's Pizza, whatever it is, right? And then they, they acquire it using their capital. But, before this acquisition, they're just sitting on this cash and the stock is going down in value. How is that possible? Money is going down in value is essentially what's happening. It's like ridiculous. That's a very, very dangerous sign, right? If they just have cash piles before their acquisition, but their stock is still going down, it's trading below $10, very, very dangerous sign that just shows there's an oversupply of SPACs. I think, guys, this one is the main one to kind of keep in mind. SPACs are trading below $10. Very, very dangerous, okay? And now, obviously celebrities are getting into it and SPACs are going down on even, news of, acquisitions, right? Before, they get an acquisition, it would go up 2 to 3x. Now, it might even go down on that news, right? So there's just not enough money to bid up these stocks. So there's no money there. Okay, in secondary offerings, we know that Lemonade has offered over $900 million. We know ASIC has offered $920 million dollars. QuantumScape also had, sold 10.4 million shares at $40. And keep in mind, this was when QuantumScape, I believe, was at $62 a share. Right, they sold, or they listed 40. They sold 10.4 million shares at $40, bringing their stock price down to I think around 40 and change there. So that was ridiculous. Skill's also offering a lot. I think 32 million shares there. Viacom obviously having $3 billion in offerings there, and that's where the issue, at least what we think for the hedge fund, came into play because they had that secondary stock offering. And then obviously the insider selling, right? If there's lockup expirations, usually these are 6 months out. So companies that were went public last year, now their lockups are expiring, and there's a wave of selling these public companies. At the end of the day, we are just being flooded with these stocks and are suffering until Wall Street wants to slow down some of the stock supply that's going on in the market. And then for the no-huddle offense, what Kramer was saying is that this is, very, very important market to kind of digest and kind of understand from. So he comes back to this idea of Archeos, the hedge fund who borrowed tons of money, and were overly concentrated. So they were first 5 to 7 times leverage, and then they were overly concentrated in a few companies, over 10% in these companies, which is not allowed, right? Specifically Viacom. Right, obviously Viacom collapsed. Why? Because they had that big offering for $3 billion. That just kind of messed it up. And then what banks realized, hey, these guys, they need to be margin called, right? And then they, took action quick, and that, just led to this big snowball taking place essentially. So what he wanted to really highlight from this entire part was that, the market is not rigged. This is kind of happening all the time. Where's the issue? The issue is really because of risk control, right? It was the banks and the hedge funds that had a problem with risk control, right? They were not monitoring that, and there wasn't something in place that they didn't see that, these guys are going to all these banks and just taking out so much money and investing so much money in huge leverage ratios that really, led to so much risk. But we've kind of seen similar things, Jim Cramer says, in growth names, right? With the younger investors, right? They're going to margin, right? And when this happens on a large scale, similar to what the hedge funds are doing, right? A lot of young investors going into margin. Okay, well, the growth names kind of get hit. Well, then there's a lot of margin calls. Same idea there. Same with the short squeezes, right? Except the hedge funds have to cover in the opposite way. They have to cover the shorts, so they have to buy in, right? So kind of these both ways are, this is not the market that's rigged. It's just that these events do happen, and we have to understand kind of what's going on. But at the end, what's the good thing out of all this Archegos, thing, this Archegos garbage that's going on, is that we're reaching a point of, in the stages of grief, we're reaching a point of acceptance, right? And keep in mind this final stage, right? Stage 1, denial, right? You start denying the truth, right? Then we see anger, right? Oh yeah, Jim Cramer is saying that the market's gonna go down. Stop saying that, because then people are gonna start selling more, right? And then we see bargaining. Okay, if the stock just comes up to where I bought it at, I'll sell, I'll break even, and I'll leave, right? Then we have depression. Stock continues to fall. You don't know what to do. You're researching the company more. You're kind of tired of it. Then acceptance is just sell all my stocks, get out of the market. You give up on the asset class, and that's kind of where we're seeing right now. But again, it's time to still trim growth, right, and get into the reopening plays. The biggest thing is to take profits while they last, right? Everybody, like in good times, will say, oh, why are you saying to take profits? Stocks only go up and things like that. But, when the bad times come, we all realize that it would have been smarter to take profits and not get too greedy at the end of the day, right? And he even goes into saying it's better to take, not even a profit, but maybe a loss, to cut your losses and start over rather than giving up on the entire asset class. A lot of people gave up in the 2000s and they haven't come back for 20 years. And that has been a major source of wealth creation in the last 20 years. So they've lost huge opportunities. So it's better to take the loss instead of give up on the entire asset class, which is a much larger loss in the long-term picture. Hopefully you guys all enjoyed it and learned something new. I thank you all so much for your continued support. Make sure to go down below and drop a like if you did enjoy. Subscribe to my channel if you're new. Turn on those post notifications so that way you're aware of when I do upload my next video. Comment down below. Till next time. Peace.